Just a quick reminder, this podcast may contain general advice, but it doesn't take into account your personal circumstances, needs, or objectives. The scenarios and stocks mentioned in this podcast are for illustrative purposes only and do not constitute a recommendation to buy, hold, or sell any financial products. Read the relevant PDS, assess whether that information is appropriate for you, and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future performance.
Hello and welcome to episode 3 of Stocks Neat, a Forager funds management podcast where we talk about the stock market and try a few whiskies and tell you what we think about them. I'm joined by Gareth Brown, portfolio manager on our Forager International Shares Fund and resident tough fullback in soccer, or it used to be anyway, back in his younger days.
Hi everyone, hi Steve.
Especially joining us today, Tamikah Bretzke, who is responsible for the start of this podcast and pulling it all together. And if you're liking what you're hearing, you can thank her for it. And today she's joining us on the podcast, perhaps permanently joining us on the podcast, Tamikah, if we can talk her into it. But she's going to, guest host today and talk us through it. We are going to talk investing in whiskey rather than drinking it. We're going to talk tech stocks and their blow up over the past 6 months, what's real there and what's market related. And we're going to follow up on Magellan after our last conversation proved an interesting one. It's been a pretty eventful time at Magellan since. So, Tamikah, over to you.
Thanks for having me, guys. A bit nervous to actually be on the podcast, but we'll see how we go. We're trying a whiskey today. We've got Lark Symphony No. 1. We took a couple of questions on Twitter, some of our other social platforms, and some of the comments that came through was on Lark, so we thought it was good to try some of that.
So for those who haven't heard this story, I'll just give a quick bit of background. But Lark has been on social media for a few of the wrong reasons over the past few weeks. Its former CEO, Jeff Bainbridge, was featured in a video that the Australian published quite clearly smoking methamphetamine and saying some horrible things. He came out in the Fairfax papers and said it was 7 years ago and he'd been extorted by some Asian gangs that had been paying them money for 7 years ago. And then the Australian has gone and found a whole bunch of photos online of a house that he bought less than 18 months ago that looks remarkably similar to the house in the video that he was filmed in. So he has stepped down from Lark. We had quite a few interesting questions on Twitter. The share price has fallen because of all of this and people asking whether it's interesting or not, but the story itself is certainly interesting.
Yeah, and I guess from my perspective anyway, just, Perennial Partners, for example, which is one of Lark's biggest investors, said, it's a 30-year-old company and Bainbridge was only there for 2 years. So I think it's a good reminder that all companies face setbacks, but when it comes to a company's history and its product, if the fundamentals are there, that often speaks louder than news headlines. And already Lark's share price has clawed back some of what it lost after the video was released, which is a good sign. But I'm looking forward to getting you guys to try this whiskey.
It's a 40% alcohol and it's a blend, and it's actually got all 3 different types of barrels. So there's bourbon barrel, there's a sherry barrel, and there's a Pinot barrel, I believe.
Yeah.
This is how most of us first experience whiskeys, with blends, with something like a Johnny Walker they buy from a bunch of different distilleries. This is from 3 different distillers. It's a nice product. I don't know, is this a pricey whiskey?
Yeah, so for 500 mils, I think the average going price for this is about $150. So it's definitely up there, but Tassie whiskey generally is, so you can sort of expect that.
If you told me that was straight out of a Pinot barrel, I wouldn't have been surprised. It's definitely got the Pinot taste to it. And interestingly, when I was in Scotland a few years ago, I've got a bunch of family over there. We went and visited a distillery, and the guy running it was telling me that you make really, really nice blends. It just got a bad name from them mixing a really well-known brand with a really cheap whiskey and selling it for a fortune. So the single barrel became just certainty around provenance rather than it necessarily being better quality. But that's quite nice. I do find the Tasmanian whiskies, there's less variety in it than And that's probably because it's all made from a much more similar area than when you look at Scotland and you've got the peat.
It doesn't have the history. It's been a couple of big personalities that have driven the whole industry rather than many generations of art.
But winning lots of awards around the world, and Gareth, let's maybe get into the investment side of investing in something like whiskey. And I guess in this world that we live in, where I would say that the direct to consumer sales path has become easier and easier through the likes of Instagram, Facebook. You can now build a brand without relying on the massive distributors to help you get it out there. So, things like this, I think, are more and more popular. What are your general thoughts on the space?
So, I mean, my kudos to Bill Lark for what he's built. He's done a very good job and basically created this industry in Australia and Tasmania. My biases here, though, is that I love businesses like beer brewing. I really dislike businesses like wine, and whiskey is probably an even more extreme example of that. To understand why, you need to think about something called a DuPont analysis. So when we look at the return on equity of a business, for those of you not familiar with it, the higher the return on equity, the better the business as a general rule. And there are various components that make up return on equity. So you have the profit margin, and then you have the asset turnover, and then you have the leverage. So just to put it simply, how much profit will I make on each dollar of sale? How long will I tie up my assets to generate that sale? And how much leverage do I use to juice returns? You look at something like a beer business, typically they have a profit margin in that 4 to 5% range. It doesn't sound like a lot. Some of them are higher, of course, but you think of the assets you use to make a barrel, to make some beer. It's you put all the product together, and 2 months later you've got a finished product. So you can turn over all those assets sort of 4 to 6 times a year. So you make your 4 or 5% margin, but you do it 4 times a year. You've got a 20 return on equity without the use of any leverage. Whereas
if you take that to an extreme, I guess even a different type of business, but a Dicker Data IT distribution or a JB Hi-Fi, something like that, where it's actually quite a low margin business, but they can turn their assets.
Woolworths is a classic, supermarkets is a classic example. They often have other people funding their assets even. Whereas, with whiskey, you get your margin, but you are tying up your assets, or those working assets at least, for a really long period of time. They sit in the barrel for, let's say 6 years if you're not got a year on it, or it's 10 or 12 if people are buying it based on year. And so you need to make really high margin there. And it's just not something I see with Lark. It's hard to. I've spent 5 minutes on the accounts, and there's a lot of stuff going through there. But it would be generous to say a 10% margin would be what they're sort of targeting at the moment. You're tying your assets up for a few years, that your return on equity is pretty rubbish. So, it's not something I would rush out to buy.
I'll tell you where you see that as well. They're all making gin, because gin is just whiskey that hasn't aged effectively. So they're trying to sell that. And you go down to Tasmania, I've been to some of the distilleries, and they're really talking down the benefits of an aged whiskey and saying, it doesn't make any difference, this aged stuff. You want to drink the early whiskey so they can sell it earlier. And then I'm sure a lot of people have seen these ads. They're all over the Fin Review, all over my Twitter feed, guaranteed 8% return from buying a barrel of whiskey. Whatever you think about the listed company Lark, I'd give that sort of stuff a wide berth.
They're taking what is difficult economics of the business and trying to ship it off to a bunch of investors so that you don't have it on your balance sheet, right?
Well, that's exactly right. And there's just been so many outright frauds, stuff not being there, people that have sold twice as many barrels of whiskey as they actually owned. There's not a lot of security around that space. And a general rule in life, there's risk-free and there's 8%.
But, I'm very cautious of, Lark published this value of leaders under maturity or whatever it is. It's an attempt to say, here's the gross value at retail price of everything we've got in the barrel right now. It's like, show me the cash and then...
Yeah, and this stock price has gone up a lot over the past few years, and it's been a bit of a a sordid history. We actually had a bunch of shareholders come and see us a few years back. They were fighting with another group of shareholders in the company, and they were trying to get out of their stake. And in hindsight, we should have bought it because it's gone up a lot since then. But the history has been patchy. Now you've got this episode on top of it. And I think you've got a lot of people putting a huge amount of weight on these management forecasts 4 and 5 years out. They're going to increase volume a lot. And I don't think you necessarily just hold margin. When you increase volume a lot, you can dilute the product. So that's one big assumption that needs to happen, and they need to hit those targets down the track. And we've talked a lot about this in some of our reports previously. I think there's different ways of working out what's going to happen in the future, different forms of information that we collect, from audited financial statements to scuttlebutt where you talk to people on the street to your conversations with management. I would put the management ones right down the bottom in terms of the amount of weight I place on them, because it doesn't necessarily mean that because they want it to happen, it is going to happen. And when you're that far down the track, I'd be pretty cautious about it. So, yeah, it's not one that we've invested in the fund. I don't think this particular issue is a massive one, but it is a more difficult business, I think.
Maybe just flip it on its head for a bit too. What do you need to see as a buyer today at 5 times book to succeed? For me, the answer is much higher margins. So you're not going to change your asset turn situation. Maybe they can apply a little leverage, but that's a double-edged sword. So you need higher margins. And I think some of these, little distilleries that are 300 years old in Scotland probably do get that kind of margin. 30%, something like that. You tie your ass out for 2 or 3 years, you end up with a 10 to 15 ROE. I think maybe Lark could get there one day. I personally think that the gap in the Tasmanian market is for a really nice $100 bottle. And I don't think they're addressing that. And I think it's an opportunity for someone to get decent, you can, though that doesn't have to be aged 12 years, just got to be a good product, and you can get 20% type margins on it, and you can build a good business. I've seen no one have a decent crack at that.
I think that's sort of one of the things that's going for the Japanese whiskey environment over there. They don't really have age statements or anything like that. If they're happy with the product, then they release it.
First time I bought one of those 20 years ago, they were, maybe a little bit higher priced than the Scottish equivalent. It's a good product.
Yeah, some of them are shut down, and so many bottles that are out there have sort of become like these rare gems that are now $400 a bottle. It's crazy.
I think it becomes a status symbol more than an enjoyment thing at some level of price and true wine and whiskey as well.
Stay tuned. We'll be back in just a sec. Are you a long-term investor with a passion for unloved bargains? So are we. Forager Funds is a contemporary value fund manager with a proven track record for finding opportunities in unlikely places. Through our Australian and international shares funds, investors have access to small and mid-sized investments not accessible to many fund managers, in businesses that many investors likely haven't heard of. We have serious skin in the game too, meaning we invest right alongside our investors. For more information about our investments, visit foragerfunds.com. And if you like what you're hearing and what we're drinking, please like, subscribe, and pass it on. Thanks for tuning in. Now, back to the chat. There are a lot of other businesses that have gone through challenges recently, not just the whiskey industry. And some of these businesses, you might see the economics can be far more attractive. We spoke about Magellan in the last episode. Did you guys want to give an update on that?
I'll let you start, Steve.
I mean, we had a really good chat, and we were, I would say, fairly glowing in our views of the business a month ago. There's been a lot happen in the month since. The guy who's been the driving force behind this business has stepped down for health reasons, and first and foremost, I hope he's okay. It can be. My wife actually said to me, watching this go unfold, she said, "I don't understand why you'd want to work in an industry like this. It's just such a roller coaster ride, and there's so much adulation at some points in time, and then everyone wants to stick the boot in at the other end of the spectrum." So Hamish Douglas has stepped down from Magellan. I think that's a massive, massive piece of news for everyone invested in both the funds and the management company as well. Chris McKay, who founded it with him, but has been really operating in the shadows of Magellan for what must be the past 10 years since he went off and ran their listed investment company, MFF, has stepped back in, I would guess temporarily to run that business. And then big investor update last week alongside the results, large buyback announced, option issuance announced, which was a very interesting one, and still paying out 90% of the profits in dividends, which I thought was interesting as well. It's pretty clear here that the profitability of this business is going down from the last 6 months levels. They already have 25% less fund than they had back then. So paying out all of their earnings as dividends, I wouldn't have been surprised if they cut it just to reset it at a level that they think they're going to be able to sustain, but they've committed to paying it out. And then, yeah, Gareth, you and I got a bit worked up about this option issuance. Do you want to explain it quickly first?
Just, you can't see on video, but my eyes just rolled back in my head then. So this is a tactic used particularly by LICs and trusts, where they say, here, you get a free option. For every share you own, we'll give you an option to buy another share, let's say the current share price over the next 5 years. What it does is gives funds a chance to double their funds under management, significantly increase their funds under management. But when you're sitting here looking at that stock, it also gives away half the upside, in effect, over the next coming years to the option holder at your expense. That was a one-for-one example that I was just running through then.
Yeah, so just really quickly, the simple way to think about that is that any value that those options have, whether they're at the money or way out of the money, is coming straight off the value of the equity. You can't create value. And they pitch these things as free options, and they clearly have a cost in the form of the dilution that you cop if you're an ordinary shareholder. So
it's free marketing for a fundy, right? It's where it's at.
That concept is important. And then, so to the extent that you just give one to everyone who's already a shareholder, the net impact of that has to be zero, other than the marketing that comes with it. So Magellan has come out and said they're doing a 1-for-8 option issue to everyone at a $35 strike price. So it's way above the current market price. Share price was up on the day. I don't know whether it's related to this, but it seems that people got quite excited by it.
Yeah, it's out of the money. It's 1-for-8. It's not as bad as the example I gave before, but it really just set off some alarm bells. This is a business that I don't see has any need for capital anytime soon, yet they're giving away options and effectively crimping some of your upside as an existing shareholder and giving it to you as an option holder. But, it just doesn't leave a good taste.
Yeah, that's exactly how I felt about it. It's not that significant, and they've given it to everyone, so it's not like it's hurting some shareholders at the expense of others. But reading between the lines, they wanted to issue a bunch of outright options to the staff to keep them, given all the turmoil that they're going through, which you can understand and which I would probably be supportive of as a shareholder. But because they were doing that, I think they wanted to say to shareholders, but don't you worry about it, because we'll give you all an option as well. And it's just distasteful, because I think it's treating their shareholders as less intelligent people than they are. And I've got a lot of respect for the business and the management team and what they've built here, like we said in our last podcast. So it is disappointing for me to see that sort of behaviour that seems like a token effort to keep
a confidence massaging type situation. The other thing I wouldn't mind talking about, if we've got time there, is Hamish's messages in the weeks before he left on sick leave. I can't remember the exact wording. It was in the Oz, I think, where he said that he'd received no negative feedback on performance.
It was in the Sydney Morning Herald. He did a big Sunday Sydney Morning Herald interview. He said he was in the best place he's ever been in his life, and yes, said that he had not had one query about performance from him.
Not one query, right? And it's just, Steve and I read that, and we talked a lot about that in the week before he left. I mean, it smelled like bullshit to everyone that's read it, which is sort of interesting. But what I found particularly, galling around that is that the people that had given him negative feedback, the institutional investors that I'm sure have been giving him negative feedback, are going to take that kind of comment very personally, because I have given you negative feedback and you're saying you haven't received it. That creates triggers for withdrawals. It definitely creates triggers for contacting the company and saying this is unacceptable. And I wouldn't be surprised if that's at least a big part of what's, I guess, triggered this departure very soon after.
And even your own internal culture. I think everyone that's working in your business reads that and says, well, hang on a minute, I'm the one that's picking up the phone and dealing with all these people that are unhappy about it. And if that's what's being said externally, then what does it mean for me internally? So, look, I really hope this ship turns around. I think there's a lesson for all of us in, I think people get absolutely idolized way too much at certain points in time, and then they get criticized far too much at other points in time as well. I really love this quote out of Ian Martin's book on RBS, and Fred Goodwin was the guy that led Scotland's oldest bank into the financial crisis and almost blew it up. And 2006, 2007, the guy was an absolute hero. And by the time the financial crisis was over, he was one of the most maligned business people in history. And his successor was actually quoted saying, I don't think Fred Goodwin was anywhere near as good as people made him out to be in the good times. And I don't think he was anywhere near as bad as people made him out to be in the bad times either. And I think that's largely true out there. There's just so much in business that is the external environment, that there's a lot of luck that's at play. Yes, you need to be good to execute on those things and you need to do a good job. But I generally think we overstate the influence of any one person. In Magellan's case, that attracted a whole heap of inflows. So that personality was very, very important to their growth. But whether you're investing with them or you're buying the management company, I think it's important to be skeptical. And that's true of anyone that's invested with us as well. We go through our periods of great performance and everyone thinks we're a genius. And then we get the email saying you couldn't pick a snotty nose when things are not going well. And those two extremes are too far in the extreme.
I've never heard that before. Pick a snotty nose.
I do note that we do get negative feedback when we're underperforming sometimes. So
if we talked about Facebook and Netflix, two other businesses that have had some challenges. Obviously, 2022 so far has been a year where stock prices of many companies like this have plummeted. What is going on exactly?
Yeah, it's been wild, Tamikah, in tech land. Most true in the NASDAQ and most true in the smaller, growthier end of the market. I've got an email in front of me from Broker Baird that's just charting the percentage of stocks in the NASDAQ index that are down by various percentages. We are now up to more than 40% of the stocks in the index are down more than 50%. 25%, 1/4 of the stocks in the NASDAQ index are down more than 70% from their 52-week highs. So you're sitting there at a third of the price that it was within the last year for 1/4 of the market. I think the first few months of this were largely constrained to those smaller companies, but we've really seen it start to spread into the bigger NASDAQ constituents over the past couple of months. One of those, Facebook, which we own in our portfolio, another Netflix, a giant darling of the growth investors that sold off 25% after its results as well. So I guess I'll ask you first, Gareth, is this just a massive market meltdown or is there something real going on with these businesses?
So I think the background here is that prices were too high. If not just in mid-2021, perhaps even by the end of 2019, they were too high. We are looking at several businesses now that have grown quite dramatically over the last 2 years, and we're back to sort of late 2019 prices like COVID, and the response never happened, like the federal government, for the feds kicking all the liquidity into the system like it never happened.
Zoom is the poster child for this. It is now completely round-tripped from where it was before COVID. Probably the number one business beneficiary of everyone working from home, attracted a huge amount of paying subscribers, now doing $1 billion a year of earnings, whereas it was sort of nothing in 2019, and the share price is way back where it was. In fact, if you had bought Hilton Hotels on the same day before the market melted down about COVID, you'd be doing better owning Hilton Hotels over the past, what are we up to now, 3 years? 2 years. You've done better out of Hilton Hotels than you've done out of Zoom.
And this is with like work from home, just dragging a whole bunch of new customers into Zoom. It's been, so we start off with a really high pricing environment there's some natural correction coming. And then I think the way it's happened, and I don't want to sound like Nostradamus here, we didn't predict this, but the way it's happened is a classic end of cycle finish. So you look at all the smaller, non-profitable businesses, they peaked between March and June or July 2021, and they've been on a downward trajectory ever since. And then you've got, let's say, Salesforce was ticking higher and higher over those times, and it's just classical investor behavior. I see a bubble, or I see a period of danger ahead. What I'm going to do is pivot to the safest. I don't want to get out of the sector, but I don't want to own unprofitable businesses anymore. I'm going to buy the leaders, the big players, and they go on for a few more months, and then they break as well. And we've seen that really, like, amongst most of the big tech companies have really busted down quite dramatically over the last 2 to 3 months.
Yeah, and that's even been true, I think, of the much more conservatively priced one. I mean, we invested in Facebook in our international portfolio. We have a portion of our portfolio that we invest in large liquid stocks that we think are sensibly priced and are going to provide us with sources of liquidity in highly dysfunctional markets. And we thought Facebook was fitting that bill at 20 and 21 times earnings. And then the results came out in late January, and they've just not played that role at all for us. The share price is down 25 or 30% since. We clearly got that piece wrong, but I think also, and this is what's set the cat amongst the pigeons even more in that whole space, is concerns around the actual revenue and profitability of these businesses rather than just the interest rate story, because it was interest rates are up, therefore all these stocks are selling off. And the linkage there is their profits and revenues and value were always a long, long way down the track, 10 and 20 years. So at low interest rates, you can make the case that was worth a lot more money today than it was at high interest rates. Interest rates have been going up, tech shares have been falling, and that was sort of the only link. I feel like the Facebook result and a bunch of other results out there have got people also thinking about what that revenue and profitability is going to look like down the track. But I think there's some little things in it that are really, really, really important. Number one, that growth slowing down there is happening across a lot of different businesses. And the question now is this 10 years of growth, 15 years of growth for all these businesses because of this shift to the cloud? Or did we actually just bring forward that 10 years of growth into 2? And now these are much more mature businesses that are going to grow much more slowly. And that's happening at Netflix and Facebook, and really across the whole space is the growth rates are slowing and people are freaking out about that. I think that's a genuine concern that you've got to get your head around as an analyst. And then perhaps the bigger concern is that all of these models for these businesses are, okay, it's going to grow like crazy for 10 years. I've got some question marks about that, but it's still going to grow a lot. But then every single one I've seen is this thing's going to make 25, 30% margins. It's losing money at the moment, but it's going to be 25 or 30% margins in 10 or 15 years' time. And I think there's a huge amount of questions about that. And we're seeing all over the place cost pressures on these businesses.
Yeah, the really great businesses, even in the growth phase, don't do that. Google didn't do that. Facebook didn't do that. They were profitable pretty damn early, and they grew at frenetic pace while making decent margin, even in the growth, their growth phase. I'm not saying there's not other models available, but you have to sort of suspend belief or something, have faith that this will show up down the track. And the other thing that you haven't directly touched on there is the stock-based comp piece, which in Silicon Valley is just monumental.
Yes.
And can just kill almost any good investment thesis when it's mismanaged.
So there's a business that I really like called DocuSign. It's an enterprise signing piece of software. People think of it just as sign a PDF and send it back, but it's much more complicated than that in businesses that need a lot of internal approvals. It's a really nice business, and it has grown at 50% per annum for the past 3 years. But if you turn that into, instead of just overall growth per annum, you say what growth per share, they have doubled the share count over the same 3-year period just through stock-based comp. So they gave as many shares away as were on issue 3 years ago. And that brings your revenue per share growth back to something like 10 or 12%. It's a dramatic difference. Redbubble, I think a really good example of the cost pressures here in Australia. This is a stock that I've always been a massive skeptic of because it gets most of its traffic from search. So
Bought some stickers on Redbubble recently.
what did they say?
What, my stickers
Yeah.
on Redbubble? I just bought some like characters, some flowers.
Dungeons and Dragons.
Dungeons and Dragons, yeah.
I was up in Brunswick Heads for holidays, which is far north coast of New South Wales in early January, and there's a sticker on a sign up there that said "F off back to Sydney, you yuppie seas." That wasn't you, was it, Tamikah?
Sure.
I think this is a really important point here, that who owns the customer? It's a classic issue, right? And Redbubble's case, they have this, they can drive revenue growth almost as quickly as they want by spending more on Google, right? Who owns the customer in that case? And I think that, we know some examples of businesses that can work around this really nicely. So Auto Trader in the UK, car sales in Australia is probably the same. I don't know the exact data, but you go to Auto Trader and because you're looking for a car, you go to Auto Trader, and it's roughly like 6-1. So if you're looking for a particular type of car in the UK, people tend to type into the bar autotrader.co.uk at a 6-1 ratio versus searching on Google for that. So they own the customer; they don't have to pay for eyeballs, and then they get the 70% margin.
Yeah. Whereas Redbubble's average transactions per customer is 1.1 per year. So most people just go there, they buy, and they don't come back. And then the next time they want a T-shirt or a sticker or something, they're back on Google saying T-shirts, stickers, whatever it is. And therefore, it's a generic commodity product. The price of advertising for that just very efficiently, it's the most efficient medium we've ever had in terms of price comparison, right? So people will bid that search term up to the point where you don't make any money out of it anymore. And Redbubble's got a long history of not making any money. COVID came along, they sold some crazy number of masks and made $50 million in 1 year. And then all of a sudden it's straight back to where it was, not making any money. It's still growing the top line very quickly. And to your point, Gareth, I think money has been so cheap, there's been so much thrown of it at the space that's also feeding into rampant cost inflation for customers. So you're seeing customer acquisition costs go up like crazy all over the place. It has woken up a bunch of offline players that didn't really worry too much about their online, that are now very focused on online. We own Adore Beauty in our Australian fund. That share price has been smashed because, again, business is going great at the top line. Cost of customer acquisition has gone through the roof as Sephora and Mecca have come online and started competing for the same customers. And then you already touched on the share-based comp, but there are only so many people out there that can do the coding and work in this industry, and you've tripled the size of it by throwing hundreds of millions of dollars of capital, billions and billions of dollars of capital, and they're all trying to recruit the same people. So not surprisingly, the cost of that labour goes through the roof. And Adore Beauty as well, I mean, it's doing a wonderful job of keeping its old customers. So the repeat business there is actually quite nice. There's something like 2.2, 2.3 transactions per annum, and that's a split of some people doing almost all of their beauty and makeup shopping on it. So their old cohorts are performing very well, the people that they've acquired in the past. It's just that the cost of the new ones has gone through the roof. So, it's a wide range, I think, of a Redbubble at one end of the spectrum where I'm really confident that all of that economic value goes to Google. At the other end, you've got the likes of Auto Trader that are almost immune to it, and then there's a lot in between. And I don't think anybody's immune to the rampant cost of labour issues in the space.
And I think the time to really aggressively add to these sort of businesses like Adore is when people are ignoring that long tail of business that they already have on the books because they're worried about the customer acquisition costs.
All right. Well, let's chat about this whiskey. What do you guys think?
As I said, I'm not very good at verbalizing these things. Yes, I just used the word verbalize. Dark color, nice, strong smell. It's relatively smooth, isn't it?
I think I personally am a fan of the individual components within this particular blend than I am of the blend.
So you actually tasted the flight, all of the whiskies that went into the blend, right?
Yeah. So last year, right before lockdowns, my husband and I managed to get another trip into Hobart. Love it down there. went on a bit of a booze tour, and Lark was one of the stops on the list. And they do have a flight, and they actually break down the individual components. So your Nant, your Overeem, and then I think it's the Lark Tawny or the Lark, another Lark port cask.
Is my guess is they're $2.50 a bottle rather than $1.75? Is that?
I'm not sure about the prices of those individual components or anything like that. But for a bottle of this, it's about $150 depending on where you buy it.
You can definitely taste that colour in the whiskey. I've really, really enjoyed it. I think just back to what you said, Gareth, it's a really nice whiskey. I think you can get a really nice whiskey in a 750ml bottle, so 50% more.
No, 700 mils, mate. It's wine 750 mil.
Well, they've got such a great sense of community down there. That's one of the things that I really like about that industry. There is they use a lot of local resources. A lot of them are friends. They help each other out. Like I went to a cidery, and I think it's Pagan Cider or something like that, and they're right next to this farm, and they produce like fruits, apples, and stuff like that, and they'll just take a couple of crates of fruit and just use that as their ingredients. And I really like the sense of community there. But
I think the whole state's done a great job on brand Tasmania as well. And as a country, I think Australia could do that a lot better, selling our fresh produce up into China and Asia. You go into a fancy supermarket up in China and it's all New Zealand dairy and New Zealand milks. And New Zealand's done a fantastic job of building their brand out as a clean, healthy place to buy your food from. And I think Australia could do a lot more of it. Tasmania is doing it well, but we could do it better across the whole country.
Well, I think we'll start to wrap up. One of the suggestions we got from a listener, I think it was over email or over Twitter, they want to hear what we're drinking ahead of time so that they can perhaps have a drink with us.
That's a great idea.
Yeah, so we might look at doing that. For the next episode, you guys are going to be over in the US, so we'll have to play that one by ear. You'll have to try out some bourbon, see if there's anything in particular you recommend people trying, if they can grab it over here.
It's not a bad idea. We also had quite a few questions about inflation and interest rates, which are huge topics out there in the investment world at the moment. And I think that next podcast, while we're in the US, is going to be an interesting time to talk about that, where across the three of us, we've got 60-something company meetings across 3 days at a huge Roth conference that's happening. Going through the list, a lot of them are down 70 and 80%. So that's going to be interesting. But also just through this reporting season we've been going through, everyone is talking about cost inflation and the problems that it's causing for their businesses. It'll be very useful, I think, and interesting to try and get a feel for whether that's going to reverse at some point in time here, or whether we're in a high inflationary environment for a long time to come.
Should be an interesting chat. Have to have fun. You're going to go to like Disneyland or anything while you're over there?
Yeah, right.
Gareth and I, the conference is at Laguna Beach in LA, and then we're off to Chicago to visit a few marijuana stocks, which have also been heavily beaten up over there, but we'll be very careful about any videos filmed or releases to the press while we're over there.
I'm pitching for stocks and spliffs for the next podcast. Let me know what you think.
It'd be a very interesting episode, I'm sure. Finish up. Thanks for having me, guys. Appreciate it. Thanks for drinking all my whiskey.
You've been a very useful guest, Tamikah, and I think we'll have you back on for sure. Thank you, everyone, for tuning in. Don't forget to subscribe and rate us on your favourite podcast platform. It's going really well, Tamikah. You're tracking the numbers. I think we've had more than 1,000 listens if you add up our first couple of podcasts, which is fantastic for just getting started. Tips and improvements and questions, make sure you send them through to admin@foragerfunds.com or follow any of us on social media.
Thanks very much.